Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters.
All right, Sonu, we're back. This is our market outlook for 2026. We're going to get into that. But first things first, I saw someone on Polymarket, Sonu. I'm going to make sure this wasn't you. Put a bet that, is it bet? I guess put bet.
I guess bet.
We'll call it a bet.
That is fair.
I think bet's okay. So that Maduro would be out by the end of January. They put down $32,000 to win $436,000. And was that you?
This was the night before, right? No,
the night
me.
before.
I wish it wasn't
me.
me.
Okay, good. Making sure it wasn't you. I'm just making sure we're not, doing something.
I know. Maybe I'd be retired. I don't know. I may need more than $400,000 to retire, but that's a pretty nice sum of money to make. And but that gets to Polymarket. I think was it the CEO or founder of Polymarket said you kind of want insider trading on this thing because it reflects all the information. I was like, okay, right. I guess, somebody knew, they bet on it, they made money. You think at the end of the day, they could have made a lot more, right? I mean, I don't mean to minimize $400,000. That's a lot of money, but hey, if you have inside information, if you're making a bet, why not more?
It's never for sure. Right? Maybe the winds change or something changed with the weather, and they would have called off what happened. But anyway, that's the wild west is out there, I guess, when you look at a lot of this stuff. But everybody, again, we're really, really excited. This is episode 169 of Facts versus Feelings, 2026 Market Outlook. We're going to dive into our outlook and all of our views and kind of a little bit of last year. Sonu, you and I, as always, we don't spend any time rehearsing this. Do we want to just give our big picture views? You want to do a review of last year? What should we do? Or do we want to drum up some excitement, make people wait a little bit? Maybe.
We should at least give the title of the outlook.
Oh, why don't you do that? Yeah, go for it.
Ride the wave. Mm-hmm. There's a wave. There's clearly a wave. Look, the markets have gained.
Sonu, isn't it riding the wave? I think it's riding
the wave.
Ride the wave. Right. We don't even know the title of our thing. We've only spent 100 hours on it, but we don't even know the exact title. But you get the picture.
A few weeks before since we wrote it. Yes, but look, there's clearly a wave. Technological transformation. We've had really solid market returns over the last 3 years, last 6 years. 132% returns for the S&P 500. So we're clearly riding a bull market, a wave. The economy, yes, it's slowed down compared to 2023, 2024, but hey, we want to participate right now. I think that's pretty much the theme of the outlook.
Exactly. On a total return basis, S&P, I guess this would have been 3 years ago. So 23 gained 25%, 24 gained about 24, and then last year total return gained just under 18%. So no, we weren't 20% 3 years in a row, but as listeners to this podcast likely remember, we came into last year with a 12 to 15% total return. What we expected, we never lowered that. Even when we were down 15% back in April, we still expected a bounce back. And sure enough, that happened in a big way. So again, we're not going to give our official views yet. We'll do it soon. Like any good entertainer, I guess we'll try to drum up some excitement here. What surprised you about last year, Sonu? We've talked about this a couple different places, but let's just spend 5 minutes or so, kind of a review of last year. What surprised you?
It's easy to say Liberation Day. Yep. Honestly, who would have expected that? That was a shock, right? And this is despite us writing in our 2025 outlook that be prepared for the threat of tariffs. But one thing we also wrote was that, look, President Trump, for good or worse, sees the stock market as kind of a report card. If markets push back, that's what we saw. Wow. The bond market and the stock market pushed back, and he pulled back the tariffs. So yes, I don't was it a big surprise? Yes, just that day. But then, the pullback in tariffs, I don't think that was that much of a surprise. I'll put this chart up. It's margins expanding in 2025. That was actually my chart of the year.
Yes.
Right. I know you like to look at it. You like to think of profit growth and margin expansion as fuel tailwinds. We'll talk about that within the context of, our 2026 outlook. But even 2025, a year ago, we talked about this. And maybe we shouldn't be surprised, but honestly, I think my chart of the year reflects the fact that companies are able to navigate tariffs really well, right? It underlines the fact that companies boosted profits by expanding margins in the face of massive tariff headwinds. Tariffs are still higher, right? Don't get me wrong.
Yeah.
Like, it was 2.5% a year ago. Right now, it's about 11, 12% effective tariff rate, right?
Okay.
And it wasn't a given that margins would expand in that April-May period, right? I mean, look, Trump was looking to change a 25-year trade regime. That's pretty much how companies made profits. But then we got the taco trade, tariffs pulled back, all of that. But companies sort of navigated all of this. They boosted margins, they raised prices. Yes, some of it passed through to inflation, right? One person's price gain is another company's profit margin increase. But they also cut costs. I think it reflects the fact that, hiring is weak. But that is also, shores up the balance sheet, right? Ultimately, it tells you how efficient companies are. It's also a productivity story, Ryan. This is something you and I have talked about for a few years now.
Well, it sure is. I guess, one of the things that surprises me about last year, 2025, is just how surprised everyone was when there was market volatility, right? We'll put this up. Volatility is total we pay to invest. We've shared this chart a lot over the years, but you tend to see volatility every single year, as you can see on the YouTube channel right now. A 3% minor pullback 7 times a year on average, 5% or 3 times a year, 10% happens once a year on average. See a bear market about every 3.5 years. We laid out a lot of reasons that the first half of last year is probably going to be volatile, probably going to be potentially weak. All right. The first quarter after a 20% gain is usually not that great. The first quarter last 20 years haven't been that great. Early in a post-election year is usually not all that strong. When you lay all these things on top of it, no, we did not see a near bear market into April. But we're not surprised by that volatility. And you mentioned, the taco trade and Trump. I mean, I can't tell you how many people I heard from in early April that I had heard from literally for 2 decades. I'm talking 2 decades. Like, they know what I do, right? They're reaching out on Facebook, whatever. And the certainty that they heard on the morning talk shows, how bad it was out there, how negative all this stuff was going to be. Now, maybe if President Trump, everybody left the tariffs where they were the whole time, maybe he wouldn't have come back. But you just said President Trump's scorecard is the stock market. People seem to forget that. And we were trying to point this out repeatedly back in March and April when all that volatility has happened, that, it wasn't even called the taco trade back then. But we were laying out why that was likely. And remember what happened, what really, really sparked it. The bond market, the 10-year yield. One night we went to sleep, maybe April 7th, April 8th, I forget the exact day, up around 5%. And then the next day, around 10:30, 11 o'clock, the tariffs came off. I remember because I was at I guess it was, what doctor was it? Yeah, I've got a different doctor I go to once a year. And I go in and the market's down a lot. All right, I'm in there for an hour or so.
You're at the chiropractor getting
things
sorted out.
I'm all stressed out. Like Soros when he's all messed up, his back hurts and the market's down. And I mean, of course, with our phones, we look every 10 minutes. I'm at a doctor. I'm still looking what's going on. Sonu's probably sending me stuff. We're still talking. And I remember coming out to my car and sitting down, and just looking and check the email, and I see we're up like 7%. I'm like, whoa, what just happened? And that was it. And everyone told us back then, markets don't bottom on a big up day. Well, that's not the case. We had about a 40% rally off those lows. So there's a lot of stuff that I think is fascinating about 2025. The U.S. market did well. Global markets did even better, as we talked about. Bonds had a really good year, best since 2020. Barclays Ag up over 7%. Gold, silver, most commodities as well, but not all. I mean, some commodities look at oil. Look at crude oil. We're going to talk about Venezuela and some of the fallout there as we dive into this more. But the reality, it was an incredible year for investors. Hopefully everyone enjoyed that. It's not always going to be that easy. There's going to be, I guess you could say Bitcoin was the one thing that was down. A lot of those meme coins were absolutely obliterated. Right. And we know a lot of people, unfortunately, have probably gone into those a little too much. That's why some of the negative sentiment we saw last year, because they're in the Mag 7 that didn't do as well. Go ahead.
Cannot work, right? Everything.
Yeah. Well, last year, most things worked, but you can't have everything. So, all right. So that's a little bit about last year. Enough about that. So let's just reveal, if we will, our targets and what we expect next year. So, Drew, let's put that on the YouTube channel. Sonu, tell us what our S&P 500 targets are, or ranges are for next year, and bond market returns next year.
You should see this on the screen right now if you're watching on the YouTube channel. 2026 forecast for stocks, and by this we mean the S&P 500. We expect 12 to 15%, which is above average. We'll talk about that as well. And for bonds, last year we expected 4 to 7%. We expected some juice from rate cuts. right? Falling yields, we got that, which is why, as you said, the Bloomberg aggregate bond index was above 7% return. Yeah. This year, we don't expect as much of, yields to fall as much. So let's say we don't expect the 10-year to fall as much. So we expect a 3 to 5% return, total return for bonds. So that's our 2026 forecast.
Yeah, and 12 to 15 might sound familiar because it worked last year. So let's just do it again. that worked pretty well last year, being in that range.
Why break something that isn't broken?
Exactly. I mean, listen, if you listen to this podcast, you probably had a clue. We were going to say we expected better returns next year. Lots of ways to dive into it. Want to start with the economy, or what do you want to start with? What do you want to start with?
We'll just put this like within the context of average returns, right?
Yep.
Like
love it.
12 to 15 is above average. And this is my favorite chart that you produce. I think I have it, like, or maybe we'll put it up. Drew, we'll get this out to you. Like the average year is not average, right? Over the last 76 years, 1950 to 2025, only 4 of those years saw an average return or return close to the average, between 8 to 10%. More often than not, it's been above that, especially when you don't have a recession. And Drew, here's another chart. History favors above average returns, even over 1-year periods, especially when you don't have a recession. And that gets to it. We'll talk about the economy. We don't think there's a recession. In 68% of years, Ryan, S&P 500 had an annual return of above 10%.
Right. So another way to put that, if you don't have a recession, the stock market's up more than double digits 7 out of 10 times. Okay. I mean, just think about that. That's kind of, listen, we're up, 82% price return the last 3 years, probably closer to 90 something percent the last 3 years with a total return. That's a heck of a run. Okay. I mean, markets don't usually go up 4 years in a row. That's the other side to this. You say, well, what worries you? Gee whiz, we're up 3 years in a row, up 15% every one of them. That's kind of a stretch rubber band. Not saying it's ultra stretch because we think it could continue, but that's a logical potential concern. Now, I do want to say, Drew, maybe we can put it back up. The average year isn't so average, and I'm aware we haven't even sent this one to you yet, Drew. So maybe make a note that if we sent Drew like 19 charts, apparently we're adding more. Sorry about that. But again, average isn't so average. The average up year is like 19% average. When you're down 14%. Of course, that you slice it all together, it up about 3 out of 4 years on average, and that comes out to like 9.5% return. Okay, but average isn't so average when it comes to investing. And if you avoid a recession, you tend to even do a little bit better, and that's where we are right now. So let's talk about that recession start. We'll get to let's do economy, inflation, Fed, kind of 10, 15 minutes, and get to the good stuff. We can kind of mix in bonds, honestly, in this conversation. So then we'll get to the good stuff, the fun stuff. It's still an equity bull market. We're going to talk about that. You don't see a recession this year. Honest to goodness, Sonu, most people don't. 3 years ago right now, when you and I did this, we said no recession. People thought we were crazy when we said that. The second line of our 2023 outlook, which came out 3 years ago right now, literally look it up. Second line said we could hit new all-time highs with some good news this year. I had a friend in the media reach out, thought it was a joke. I'm serious. That was the attitude. They could not. Now, technically, the S&P didn't hit new highs until January of 2024, but the Dow did. But it was still an incredible run back in 23 when nobody expected it. Why do you think the economy is going to continue to do pretty well this year?
I mean, even in 2024, I think there were a lot of people saying, there would be a recession.
Well, in April. I mean, in April, everybody did. Literally everybody did. By the way, let me jump one more thing in. 21% of large cap fund managers outperforming the benchmark last year. That is like the lowest we've seen since 2016, ballpark 10 years. I think a big reason, everybody says they're bullish when they're on TV or do this stuff, and then April happens, and everybody pulls back. Maybe, again, you pointed out to me yesterday at a call we did with our advisors, it's not like they just move the cash. You have to be in equities, but maybe they went to the real defensive stuff back in April, and then they missed the move up, and that is why most fund managers, I say most because we did okay, but most fund managers had a rough year last year. Go ahead, Sonu.
No, speaking of we did okay, by the time this podcast is up, which is Wednesday, January 7th,
okay, we
will have a blog up on our carsongroup.com/research page. What we got right, what we got wrong last year. Right? We talked about tariffs and things like that. We wrote about that, the threat of tariffs, but we also wrote that expect to see market volatility in the first half of the year, double-digit drawdowns. Yes, we didn't see 19% drawdown in a bear market, but still we expected that volatility. That's how we positioned portfolios too. We were overweight equities, but we had that momentum, low volatility barbell, which worked out. So I talk about that as well in the blog. This year, look, the economy is hanging in there. Let me give you one data point from just yesterday. This came out after, we wrote the outlook and all of that. Auto sales. Auto sales in 2025 averaged 16.1 million per month as an annualized pace. That's more than 2% above the 2024 pace of 15.8 million, right? When you hear that, is that reflective of an economy that's on the verge of a recession? Come on, no. Is that reflective of an economy where the labor market is falling off a cliff? No. Yes, the unemployment rate has gone up. It's up to 4.6% now. We'll get new payrolls, December payrolls this week. Hiring, of course, it's weak. April to November, payroll growth averaged 35,000 per month. Over the prior 15 months, January 2024 to March of 2025, it averaged 156,000. Maybe that gets revised down, but use it. 3 of the last 6 months saw negative payroll growth. That's not good, right? But at the same time,
can I jump in just for a second, Sonu? Let me just put context around this. Yeah. So, actually, it's 7 months in a row now that the jobs have been up, down, like alternating, like song, right? So that would be exactly. So we're going to the jobs numbers later this week. We're probably going to be positive, but who knows? We might. Yeah. So if we're negative, that'd be 8 if my math is right. That's the longest streak like in history. There was a time in the early late 60s, early 70s where we had like 6 alternating. This is the longest ever alternating between up and down on jobs. That right there tells you it's not necessarily bad because you're getting some up months, but it's sure as heck not good because you're getting some down months. Yeah. It is just that the ultimate indecision is in the jobs market. 7 months in a row alternating between up and down. Go ahead, sorry.
And down months are never good. Like if you asked me, a year ago, anytime before this, what would you expect if you saw a negative payroll? I'd be like, we're in big trouble.
Yeah.
Period.
Yeah.
Right. But yes, the unemployment rate has also gone up, but it's edged at like 4.3 to 4.6%. Yes, that's concerning. But payroll growth is weak. We do have a lot of noise in there, right? Immigration's fallen off a cliff. So the economy needs to create fewer jobs per month to keep up with population growth.
Yep.
Before 2025, maybe that number is 120,000. Now, estimates are all over the place. I don't think anyone has a clear picture. Some estimates say it's like 30,000. Some say it's 50,000. Some say it's 60,000, right?
What do you say? What do you say, Sonu? In the middle?
I'm not a labor economist or, I think this data, I think hopefully I recognize that this is a tough game to predict and forecast.
Sure.
But I think honestly somewhere between 35 to 50,000. Again, that's
I'll say between 0 and 500,000, somewhere in there. Somewhere in there is the number we need.
There you go. But economy. But at the same time, layoffs are low. Every Thursday, the first thing I look at, which I recognize most people don't get excited by, I look at initial claims for unemployment benefits, and claims are still running really low. It tells you that layoffs are low.
Last week was 199,000. Maybe there's some wonkiness with holidays, whatever. 199,000 is really a low number going back 75 years with data.
And then the employment population ratio for prime age workers, 25 to 54. I recognize this is a lagging indicator and all that. Still, it gives us a picture of what's happening now, right? That's at 80.6%. That is higher than at any point between 2001 and 2019. So yes, hiring is weak. But I don't think the labor market is falling off a cliff.
Yep.
And this is one reason why we populate our own leading economic index so that we're not swayed by one. Like I said, you can't do indicator macro. You can't say, ISM PMI is terrible. Sell, right?
I heard that 3 years ago, by the way. That you couldn't turn, if you did a shot, every time on CNBC, they talked about the yield curve inverted. If you talk the ISM PMI sub 45, talk the LEI negative year over year, talk about the Solomon indicator, you would be drunk. I mean, you'd be drunk before lunchtime. I mean, you'd be hammered. You'd be passed out by lunchtime is what I should say. Yeah. That's all we heard, man, 3 years ago. It's all we heard. But let's put on the YouTube channel now our proprietary LEI, Drew. Go ahead, Sonu.
Yeah, and this combines a lot of different indicators. By the way, including the PMI, I'll give it away, including the ISM manufacturer PMI. It's in there, but it's got a lot of other stuff. It's got, like I said, auto sales. It's got retail sales, housing starts, all of this stuff for the unemployment rate, right? And right now, it doesn't point anything close to a recession. It tells us, in fact, it tells us what it did a year ago. The economy is likely to grow close to trend, about 2.5% growth, right? Okay. That's what GDP growth. I mean, if you look at core GDP growth, throw out inventories, exports, gone all over the place.
Yeah.
Over the last 3 quarters, real demand, right? Core GDP growth clocked in about 2.5%. That's kind of, or about 2.2, 2.3%. That's slightly below the 2010, 2019 trend. yes, it's weaker than 2023, 2024 when we got near 3.2% real demand. GDP growth is about 3%. Even last year, we expected things to slow down a bit. We didn't expect a recession. Mm-hmm. I think it's the same thing this year. We think growth will clock in a long trend. And yeah, I that's not bad for profits, by the way. I think nominal GDP, which is where revenues come from, will be around 5%. That's a very good scenario for profit growth.
Yeah, we're going to combine a couple things as we'll talk earnings, maybe we're going to talk stocks. But listen, the S&P 500 earnings this year, 2026, expect to be about 14%, right? What was last year like? Or actually, we just don't have last year's numbers. We don't have fourth quarter yet. But last year, obviously, was strong, too, in 2025, much better than everyone expected.
You're clocking around, at least, or let's say around 10%.
Yeah, 10, 11, thought 10, 11. But buddy Sam Rowe, right? Sam Rowe over ticker, he pointed this out. It came from FactSet, but Sam noted it. If you look at the analysts, what they think at the start of the year and where earnings are, usually they come in within 1%, Sonu. Now, there's always a caveat. That's if something extreme doesn't happen, like a great financial crisis or 2022. So if the economy does okay and we have a decent year from the economic front, which is our base case, earnings might come in right around 13, 14, 15%. I'll tell you, I don't know. Maybe I'm glass half full to a fault. I think it could be a little bit better as we get better productivity from AI, different things taking over. And honestly, the labor market coming back. We just had, again, an economy that was virtually shut down in April for a couple of days. Everybody freaked out. Nobody knew what was going on. TV told you how bad it was. Everybody's selling their equities and getting out. Companies heard that. Companies felt that, right? It's going to take a while to bring back confidence, I think, with the uncertainty over tariffs. And maybe that's another reason next year. But so we can go all day on this. Want to talk about the F word? Want to talk about the Fed, inflation? You want to go that route or what else you want to talk about?
The economy is hanging in there, right? We'll look, maybe we should talk about the AI story after this. But I think when I think about policy, right, generally, what are tailwinds for market? Yes, the U.S. economy is hanging in there, but I think global activity is picking up as well. Yeah. Developed markets are growing above trend. Now, trend hasn't been great in developed markets over the last maybe decade and a half, right? So when you say above trend, maybe it means 1.5% to 2%, something. I mean,
Europe hasn't grown much the last 20 years. That's just,
right, exactly. So, but then activity is picking up. EM is sort of hanging in there. Activity is back to trend. China maybe 5% growth. I don't think they slowed to 4%. But Taiwan, South Korea, that's all part of the AI story. We'll talk about that. But then, you think about policy tailwinds. Last year, there were some headwinds, tariffs. I think the tariff headwind is fading. Just a few days back, I think last week, Trump delayed more tariffs. Tariffs on furniture.
On the 31st. I think they're supposed to go into play, and on the 31st, exactly.
It's like vanities, kitchen cabinets, furniture, maybe now is the time to go, redo your kitchen. I don't know. But anyway, the tariff headwind is fading. Tax cuts go into effect right now. That's retroactive to 2025, by the way.
And that's from the One Big Beautiful Bill, right? The tax cuts.
Exactly. I don't know how many B's are in there.
I don't know. That's true.
Triple B or 4 B's or something.
Yeah.
But anyway, I think people are going to get a lot of outsized refunds. And refunds they don't expect. People expect refunds anyway. I don't think that adds much more to, spending or consumption. But when you get an outsized refund, which you don't expect, I think that becomes like, oh my God, I've got more money now. What do you think that happens with that? This is from SALT deductions, right? State and local income taxes. That deductions increase from 10,000 to 40,000. Tips can be deducted. Seniors get a higher deduction as well. So there's a lot of refunds coming in Q1 and maybe into Q2 as well. And then, so there's a fiscal policy tailwind and then Fed cuts, right? I think, the Fed cuts another two times at least. If it doesn't happen in Q1, and that would be assuming the labor market holds up, right? If the unemployment rate doesn't go up further, maybe, rate cuts get pushed to Q2. But I think we still do get it, maybe after a new Fed chair, after Powell goes away. Yeah, unless the economy is really booming and inflation's a big problem, goes back to, let's say, 4%. I don't think that's the case. But we're kind of in a Goldilocks scenario, Ryan. Like, if the labor market weakens a bit more, but not enough for a recession, right? So profits still hold up. We get more rate cuts. Kind of what happened in 2025.
Okay.
If the labor market doesn't weaken, if hiring picks up, which is what I think will happen, we may not get many rate cuts, but we still get strong nominal GDP growth. That's also good for profits. So I think 2026 is set up really nicely.
Well, given we're overweight equity, Sonu, you better.
Thank you.
No,
no pressure.
I was going to say something that's funny. The Fed. Okay, so listen, we can talk about the Fed a lot, and we do on this very podcast virtually every week. And I've said this before, but I'll say it again. 3 times in the fourth quarter last year, the Fed cut interest rates 0.25%. We call it 25 basis points. So 3 different times they cut 25 basis points. Sonu, every single one of those times, I think it was September, October, December. I'm pretty sure. Yeah. September, October, December, those 3 cuts. When the Fed cuts within 2% all-time high, like every one of those were, it's happened 22 times in history. S&P 500 is higher a year later, 22 times, up like 14% on average. The old saying, don't fight the Fed. I like to keep it simple. We have more of a dovish Fed, right? And again, I'm going to kind of combine some things. We'll talk equities like next, but it is a midterm year, and midterm years historically aren't that great for the stock market. Okay. The last 2 midterm years, 2018, 22, what happened? Well, we had like bear markets, both of them, and stocks were down, both of them. 22 was a terrible year. I mean, in a way, 22 is the exact opposite of what just happened, because in 22, bonds had the worst year since George Washington was president. Stocks were down 20% with a 25% bear market. Gold was virtually flat, so you could say it's the best asset, but it was still flat. Crypto was annihilated. Global stock markets were crushed. And the exact opposite just happened, really, for the most part, with everything up last year. But again, if the Fed just cut, and here's where I was going with this. In 18 and in 22, I would argue that those big sell-offs happened because we had more of, a hawkish Fed, right? In December 2018, the Fed kind of threw some hot water or cold water on the rally and didn't give the market.
And that was a midterm year too, right?
That was a midterm year, and we had that big sell-off in December. If you were there, you remember. It was, everybody says, Christmas Eve is like usually the best day of the year. No. That was not the case back in 2018. And anyway, and then 2022, a lot of other factors, yes, but the truth is the most aggressive Fed policy we'd seen in a generation sure didn't help things. Where are we going now into this midterm year? We have more of a dovish Fed, at least as of now. But I do want to talk one more thing about inflation, Sonu, because I think about like, where are we a little different than a lot of other places, right? We're bullish. We've been bullish. I look around, a lot of places are bullish now. We like international. We'll get into that. Emerging markets. Okay, that's fine. A lot of people are talking about that. But I think we're thinking inflation maybe stays a little stickier, right? I'm seeing a lot of people saying inflation will come back because of shelter, and I don't disagree. I mean, shelter is probably a positive tailwind. But why do you think inflation might be a tad stickier than maybe your average large research shop out there?
I think this is where we're probably a little different from, and these are people I respect a lot. They think inflation is going down because of exactly what you said, sheltered inflation, and they see weakness in the labor market. So there you go. I think hiring picks up. But usually if the labor market is weak, yes, you will see inflation going down, but that's because the economy is weaker too, right?
Okay.
Last year was a good example. 2025, the unemployment rate went up. Hiring was weak. But inflation was sticky around 3%. Never mind, there's some, weird things happening with CPI and because of the data dump that we didn't get. And, the data hole, I should say, because
when Sonu was so depressed, there was no economic data. Fired. He just had nothing to do. He's just wandering the hallways, wandering the streets of Chicago.
Growing a beard.
Excuse me, sir. Do you know what the initial claims are by chance?
But another thing, I think the labor market may stop cooling. Hiring could go up in 2025. By the way, one thing is that wage growth is still strong.
Yeah, good
in
point.
2025 is running ahead of the pre-pandemic trend. If you look at the employment cost index, the gold standard of
which no one looks at but you, by the way. No one looks at that but you. So tell us what it said.
Excluding incentives, it was running at 3.5% year over year. Before the pandemic, 2018, 2019, strong job market, it was about 2.7%. Even if you look at the Atlanta Fed's wage growth index, that's running about 4.1%. It was flat in 2025.
Oh, wow.
But before the pandemic, it was about 3.5%. So wage growth is still running ahead of the pre-pandemic trend. And I think that's kind of what, I know you hear everything, a K-shaped economy and things like that. But if you just put it simply, wage growth is still strong. And I think that's what's holding up spending, if you ask. By the way, side note, maybe it's connected too, when you talk about consumption and spending. 2026 is what I'm looking forward to is it's a massive sports year. I know Super Bowl's coming up and, the Winter Olympics. I'm not a big Winter Olympics person, but my wife watches some of the, the skating and things like that.
Sure.
This is, I recognize, not interesting to anybody listening to this podcast. Maybe some friends in India, not to you, Ryan. There's a Cricket World Cup in March. But there's the Soccer World Cup in the summer in the United States for a month. What do you think happens to spending?
Oh, yeah.
Right. By the way, then there's a President's Cup golf in Medina, Chicago, Ryan. Hopefully I can drag you here for that.
Oh, my.
There's a Rugby World Cup in November. But there's one.
By the way, I've been to the Medina Country Club. Shout out to Carson Wealth in Chicago.
Yeah.
I've done a lot of client events the last, 15 years. And there's the buffet, and everybody gets to the buffet, and there's the steak, and it's fine. You know, steak's kind of overcooked because it's been sitting there for 30 minutes.
Sure.
The Medina, shout out to the Medina Country. It was absolutely the juiciest, tastiest filet I've ever had. That was just sitting in a thing, and you take it out. So if it's at the Medina Country Club and anybody wants to get me a ticket, I'll go. I will be there. I will be
shout
there.
out to our friend of the podcast, good friend also, Chris Conmey.
Oh, yeah. Shout out, Chris.
He invited me over, this was about a month ago, crap shooting at Medina. Right? And it's the first time I ever shot a gun in my life, by the way. I have never done that. Right. And this is, I didn't know what was happening. But by the way, I knocked out 3 or 4 in a row, first 4 shots. Beginner's luck. And after that, nothing happened. I was terrible. I got a massive bruise and all that. But, no, it's a fantastic place. Again, Chris, thank you. Side note. But by the way, June, there's something maybe even more important, Ryan. Like the World Cup's happening, obviously, June, July. There's the College World Series in Omaha, too. So, since Carson, obviously, Omaha-based company, that is a big thing that happens around that time of the year. There's a UFC fight at the White House in June as well, right?
It's true. I was wondering where you're going with this.
But no, I'm not done yet. Taylor Swift is getting married in June in Rhode Island.
Oh, my. Okay.
Right? So there's a lot of things. Maybe it's tangentially related to sports now, anything related to Taylor Swift, but I just had to throw that in.
The Cricket World Cup, where is that one going to be?
India.
It's in India.
Yeah,
you
going?
You're gonna try to sneak over? Can't do it.
No. I'll be with you in Miami in March.
That's true.
That's true. Looking forward to that. But
how were you just traveled a lot? How were your travels? I mean, you've been all over the place, man. Every time I talk to you, you're like on an airplane, or it's like it's 12-hour difference time zone. You doing all right?
I'm thinking, okay, my back isn't probably doing all that great. No, I'm just getting old, but hey. The global economy is humming. It's not the people all over the place. You and I start traveling in a few weeks. I'm sure the airports will be full. And that's why 2026. I mean, we are both sports fans, maybe different sports. I don't know anything about American football.
I hate American football right now. All my teams lost. I hate it. I know.
I did see the OSU game, but I won't bring that up. I was with my father-in-law, who's also,
he
Columbus,
probably was,
Ohio.
I know.
He shut it off after my kids are watching with him, and he shut the whole thing. My kids are looking forward to spending like 3 hours watching the game with him, and Granddad turned the TV off after the first quarter and a half, and they're like, "Oh, what do we do now?" I'm like,
wow, he really gave up. Okay,
he really gave up. He's like, so we didn't. I kept track of the score and things like that. So anyway, it's sports.
Yeah, sports. So
what are you talking about? Consumption. You're talking about consumption and all this activity, right?
People flying around going to sports, and honestly, that's a lot of it, right? I mean, there is. So you've got fiscal policy, we've got monetary policy, we have the AI spending, the capex, which shows virtually no signs of slowing down. Did you add an AI chart?
Let's talk
or not. I want to do that for a second and then get the equities.
Let's talk about AI, right? Look, we are in the middle of like a massive capex boom. Drew, we can put this chart up. Big tech capital expenditures. Total capex in 2025. In 2024, it was $240 billion.
Right.
2025, that went to $400 billion. That's insane, right? More than 50% increase. 2026, the rate of growth may not be as much. Look, the numbers are massive still. It's expected to be about $515 billion, right? Look, these companies, and this is just like...
This is just the Mag 7 companies, right? This is
not even Mag 7.
Just the biggest
Microsoft,
five.
Alphabet, Amazon, Meta, Oracle. By the way, I still feel weird calling Google Alphabet. But anyway, it is,
I hear you. Yeah.
But like these companies are massive cash flow generating machines. But I think, look, right now, there's all these data centers, credits getting used to build data centers. So the financing piece is also getting interesting. But each of these companies feel the need to win, quote unquote, win that AI race. I think it's existential for them. And that is why they're going to continue spending. We're going to get this big CapEx wave. And remember, one company's spending is another company's profits. And spending, as I said, on AI investment is massive right now. And that's one reason, I feel like we have to ride that wave.
Yep.
Now, yes, some caution is warranted. There's a left tail risk of a crash, but that's down the road. I don't think, honestly, 2026 and maybe not even 2027 is the time for it. But that's also why you need a diversified portfolio. Right? You want to participate. You don't want that right tail risk of missing out in case this is like 1997, 1998. But at the same time, be diversified because, look, investment booms usually end with busts. You're looking at railroads, telecom, and even over the last 25 years, housing in the 2000s, energy in the 2010s. So surf the wave, but don't be underexposed, but don't go all in.
Okay. No, that all makes a lot of sense there. We'll get to equities, a little bit. Two quick things. So my elbow's been hurting me for a while. Like, I don't know why, just sometimes more than others, and I finally...
Did you go trap shooting as well?
No. So finally went to the doctor and they did the scan. You always worry, like, what's it going to be? I apparently have something called tennis elbow.
No way.
I said, but I don't play tennis.
I've heard of that. I used to play tennis. I've never met anyone with tennis elbow.
It's my left arm. Now, I'm notorious for, I'm in a chair right now. I've had back issues. I'm actually fine now. I like to lay on my stomach. Like literally 4 hours a day, I lay on my stomach and just type away. So I wondered if all the pressure on my elbow was maybe doing it. They didn't think it was. I don't know. So my wife bought me like this special body pillow. You lay on the ground and you lay on it so it doesn't put as much pressure on your elbows. Anyway, so I have tennis elbow. But also, our team was, that's whatever.
Sorry to hear that.
Doesn't
sound pleasant.
Well, apparently it's easy to fix. You just do these exercises, which I haven't even done yet. Go figure. It doesn't hurt that, but it's like a 1 out of 10. It's just more nagging. Our team got a pretty good honor last week, Sonu.
Yes, I was going to bring that up. I had my notes, but
Business Insider named their Oracles of Wall Street in 2025, and they chose me as one of them. Now, I would be very clear to point this out. I mean, I guess it's my face, but obviously it's our team, right? Our team, the Carson Investment Research team, the things that we say, the things that I share publicly and you share publicly, we do on this blog and do all this stuff. But it was really cool because they took different people. Jeffrey Gunlock, they picked the Bond King for his bullish call on gold, which is obviously works. Some other big industry names are in there, and our call was really being bullish. And honestly, in late April, when we were saying the lows are probably in, the economy is going to do okay, and the market took off and went up 7 straight months in a row, 40% gain. That's what they cited for us, but it's a nice honor. So thank you, Business Insider. And actually, we got this in 2023 as well, when we were bullish in 23 and a lot not
why not 2024? What happened?
That was my joke. I took off 24. I don't know. I didn't do much in 24.
No, congratulations, dude. It's well deserved. Yeah. I know you said it's a team, but you deserve a big, you're number one.
Thanks.
I don't even know why some of the other people on that, not to knock anyone else, but I remember, what. Some of the folks are like, wait, weren't they bearish, or aren't they always bearish? And I won't name names, right? But look, you were saying in the middle of April, and I'll quote because I have the article in front of me. You told CNBC at the time, we are at the ballpark here of a pretty significant tactical low.
Yeah,
doesn't get better than that.
Yeah,
that's it. Right? Congratulations, dude. Well deserved.
Yeah. Well, thank you. So that's cool. So it just helps the Carson brand and getting our stuff out there, and the media. I mean, literally every day, you and I get asked by the media to do something and do this and do that, which is really neat because they're seeing what our team is doing, not just from the communication side of things, but we also manage, over $7 billion, right? So, and we've done pretty well overall. I mean, some places better than others, don't get me wrong, but overall, we've done pretty well with a lot of our calls, and it's an honor to work with our amazing Carson partners every single day and in this amazing Carson community as well. So, Sonu, we've got maybe 10 minutes, give or take.
Maybe equities. I'll set the tone here. Look,
let's set it. Yeah.
What drives equities? Of course, two pieces: profits, valuations. In 2025, in fact, the last several years, it's been profit growth. Right now, where do profits come from? This is why we talk about the economy, nominal GDP growth, right? But also investment, right? AI capex. That's one reason we feel like profit. Like I said, one company's spending is another company's revenue and profits, right? So that's a big driver of profits. Deficit spending too. We talk about the tax cuts and household, lower consumer savings, right? That's also adding to profits. All of these are tailwinds, global activity picking up as well. And maybe we can put this chart up, right? I know you like this one. Forward earnings expectations are still rising. Take it.
Love it. Well, keep it simple. If forward earnings are continuing to go higher, that's normally a tailwind for equities. And we've been sharing this chart for 3 years now, talking about this going higher. And you already shared the profit margins. We're looking at potentially record profit margins this year and record earnings. I mean, if you think about that, those are the dual tailwinds through this bull market, continue to justify kind of where we are. Things aren't perfect. We talked about some issues with the economy, but if earnings are still strong, corporate America is solid. Balance sheets in corporate America are still in really good shape. Honest to goodness, balance sheets in households are still pretty solid as well. Those are all reasons to think that this bull market's alive and well. And then you look at the geeky stuff I like to look at, things like advanced decline lines. How many stocks are up versus down? Sonu, just late last week, we're hitting new all-time highs on the S&P 500 advanced decline line, New York Stock Exchange advanced decline line. Market breadth leads price. And I think that's really important along with these strong earnings to justify. Now, one more thing I want to point out, it's a midterm year. So Drew, we can put this one up now. And honestly, Sonu, what's the title of it? It shows the 4 years of the presidential cycle where midterm years are down 17.5% from peak to trough. So Drew, it's that chart. But the reality is midterm years don't usually do that well. On average, this is on average, but they do see a good deal of volatility.
Average is skewed by 2018, right?
It's skewed, but I mean, honestly,
and 2022.
Big pullbacks are still kind of normal in a lot of these. So I wouldn't be shocked at all if we had a 10 to 15% peak to trough correction some point during this year. Yeah, I think that would be normal. Honestly, just updated the numbers. Since 1980, the average peak to trough correction is 14.1%. All right. So now, yes, some years have more, some years have less. But after this rally we've had, there still could be some volatility. But when it all is said and done, we think that volatility will be an opportunity and likely continued higher prices. Now, one other thing that's interesting, and this really, I mean, my goodness, this fired up the Twitter sphere. It's the 6th year President Trump, right? Love it or hate it, it is what it is. It's the 6th year under President Trump right now. And when you go back to 1950, Sonu, you look at presidents that made it through the 6th year, stock market's never been lower. 5 out of 5 times it's been higher. And I get it. This is not 6 years in a row. Those other times were 6 years in a row. And you really want to play with some numbers, Sonu. If you look at President Nixon, his 6th year in office was 1973. He was removed from office in August of 73. Okay. So stocks were down a ton in 73, sure. Like significantly.
And we had a recession too.
And we had a recession. So no, I'm not counting that because he didn't make it through his 6 years. So there's asterisks all over this. I get it. But at the same time, I can
see why the Twitter is up and down.
But if you don't think you're going to have a recession, and this is technically his 6th year. He's a lame, maybe let's call this, he's a lame duck president. I don't know about this lame duck stuff or not, but I do know that, maybe there's certain policies, things that can happen that you're just not as worried about when it's your first term. I don't know. I mean, I'm just looking at the history, but the reality again is 6 years of presidents tend to do pretty well. We're in the 4th year of a bull market. We talked a lot about this. 3rd years of bull markets can be choppy, can be frustrating. If you can get through that, and that's how last year was, the 4th year tends to be really strong as well. So you stack all this on top of it with those fundamentals, with the monetary policy, with the fiscal policy, with the broadening strength, with the lifeblood of a bull market is rotation. Tech hasn't done as well. Well, gee, have you looked at not utilities, wrong one. Have you looked at industrials? Have you looked at financials? There's other groups that have taken the baton, which is perfectly healthy and normal. So let's talk about the globe, because again, I think maybe we go back to surprises. I mean, I don't think at the start of last year, well, in fact, I didn't think Europe would gain over 30%. I didn't think EM would either. We changed our tune a little bit as we got into February and March with some fiscal policy coming out of Germany and other parts of Europe. But even then, to see the rest of the globe do that well, I'd have to classify that as a surprise. Can the rest of the globe keep doing better than the U.S., you think, in 2026?
I think so. I mean, look, in terms of our positioning, so I'll talk about the portfolio as well.
Yep.
We are neutral, right? Last year, and this gets to, yes, we release the outlook, but keep an eye on our blogs as well, because sometimes, just there's that old saying, when the facts change, you reserve the right to change our mind. Yeah. Right. We went into last year this time. You can argue in hindsight, okay, that was a wrong call. We were overweight the US, but pretty quickly
we changed. Yeah.
We switched to neutral weight international versus the US, right?
Mm-hmm.
And this is while being overweight equities, I should say, right? And we are overweight large cap stocks. We're getting, like I said, you want to diversify. What's a good diversifier right now, right? EM, I think, is still part of that AI story. You want exposure to that.
I thought you were going to say I thought you were going to say Melania coin. That's not a recommendation.
And not a recommendation, by the way. Yeah. But I think developed markets, like I said, activity is picking up, more fiscal spending, right? Especially places like Germany. You look at economies like Spain, Netherlands, even, stuff's going on pretty well over there. Oh, yeah. I think those tend to be, I hate to call them like value baskets, value stocks, but they are good, relatively diversifying, to everything else in the equity market, especially stateside, right? So we are slightly overweight developed markets, slightly underweight EM. We are barbelling the exposure to technology communications. We have reasonably neutral to slightly above neutral exposure to technology communications. Right. But we have industrials. And when you think Europe, what do you think? Industrials. We have some low volatility even, right? Be a little more risk efficient, trying to be risk efficient. But that's the way we are positioned, globally, right? We probably have a bigger weight to international stocks than probably and most of their model portfolio managers in the business.
Yeah, and that was, again, I hope I don't butcher it live while we're doing this. The Lou Holtz quote, Lou Holtz, famous football coach. He said, life is 10% what happens to you, 90% how you respond to it. I got it right. That's good. And I love that quote because, again, we changed our tune quite quickly in 2025 on Europe. And we said, there's something, you specifically said to the team, listen, there's something going on here. Then I kind of look at the charts and the sentiment and say, yeah, this lines up. And my bigger, I guess, call that worked out well was a lower dollar last year. Trust me, a year ago right now, people thought you were crazy. My buddy Chris Kimball, who joined the podcast last week, Scott Brown also, that was incredible. We've had a huge amount of views on the YouTube channel, so thank you for that. Oh, by the way, this YouTube channel, give us comments, positive, negative, I don't care. Just give us comments. We can take them. That helps the algorithm. But Chris was one of the few people a year ago that said, look at the dollar, it might be peaking. I looked at some things and agreed. And a lower dollar clearly has been a tailwind for metals, yes, but also the rest of the globe. I think that's a reason the rest of the globe did well. So my take on Europe, I still like it. I'm with you. I still like it. I look at an asset class like the stock 600. All right, that's Europe. That's kind of the European Dow. It earlier this year, Sonu, broke out above levels it was trading at in 2007. Would I see an asset class literally go nowhere for 16, 17, 18 years, whatever it is, and then break out? It's hard for me to think it's going to just stop going up. It's going to stop outperforming. I think there's real opportunity for the rest of the globe. Maybe U.S. gains 12 to 15%. Maybe emerging, or maybe the rest of the globe gains 20. I don't think it's going to be literally, you did the data. I think Europe outperformed the U.S. by 20%, which is the most we've seen in like 20 years, something like that, right? Am I ballpark right on that one?
By about 15% or so, yes.
Okay.
Exactly. Yeah. No. And even in local currency terms, Europe outperformed. But then you add the dollar impact, weak dollar, stronger local currency. Yeah, that was a massive tailwind.
Yeah. Let's talk EM. We just had the news out of Venezuela. We could talk a lot. And by the way, people ask me all the time, if, what do Carson partners get? That we give a lot away. We're talking how we see the world here. Well, we manage real money, and our portfolio is done very, very well. And if you don't want us to manage your money for you as a Carson partner, we show you exactly what we're doing so you can go along with it. But you do what we call Sonu's Daily Note, which I don't know. I think we should sell it.
I'm surprised we still call it Sonu's Daily Note because
what else are we going to call it?
No, I know.
I love it. I know.
Sometimes when I'm traveling, I feel like I've been traveling more, so I've skipped more of them. So it's still a day. I try to do it every damn.
Sonu did a daily note. I guess it would have been yesterday or 2 days ago. And all this stuff. How many words was it? Like 5,000? I don't even know.
I think it was about 3,000.
Okay, it felt like 5,000. When I read it, it
like
felt
a mini
like
outlook.
It was unbelievable the amount of data and time and thought that you put into this for our Carson partners. So if you're thinking about what do I get if I come to Carson from the research team that I'm not already going to get, listen, there is a lot we do behind closed doors, and Sonu's Daily Note's amazing. So Sonu, Venezuela has 3.3 billion with the B barrels of oil. There's like another 500 million in the ground that we think
300 billion. Yeah, 300 billion barrels apparently.
303 billion. Yeah, and another 500 million in the ground that maybe we can get. It's going to take potentially years to get it out. Yeah. What all's going on? How do I put this? Latin America was up 2%. Okay, Latin America stocks. There's an ETF. Latin America was up 2%. The markets rallied globally. Energy stocks went higher. Gold went higher. Everything went up. High level, what's going to happen with Latin America maybe if this kind of goes through to be a positive?
Look, the narrative is actually interesting. Like even just that 300 billion
How do you store that? I mean, how much is that? Like a barrel's a big thing.
Yeah, no.
Crazy.
This is stuff that's in the ground that's yet to be pulled out. That's what,
okay.
But then, I've been digging into, this is why X, I should say, is fantastic. Like, if you know how to sift through a lot of the craziness, a lot of the rubbish, there are some amazing people on X. Like, shout out, like, you all know who you are. And I share messages with them. I look at the tweets. It's amazing information you can get. My job is, I think, pull it all together, make a story out of it. That's what you do as well. We create our own charts, things like that.
Yep.
And the narrative is, they've got 300 billion barrels of oil sitting in the ground across, all these different places. And I was like, where did that number come from? Okay, JP Morgan or whoever. Where did JP Morgan get that? OPEC. Where did OPEC get that number? They got it from Hugo Chavez 20 years ago. Because he was like, one day they were at, we have about 100 billion barrels reserves, stuck in the ground. He's like, if I boost that, if I triple that, right? Say we have 300 billion, makes us look better. That's essentially what the number is. Is that actually real? Who knows, right? But the other part is it's all really what we call extra heavy crude. This is almost like tar.
Right. Yeah.
When you pull it out of the ground, you have to dilute it. You have to sort of melt it, right? This stuff is very hard to take out of the ground. So, and then like if they produce, last year production was about slightly under 1 million barrels per day, right? At their peak, they were producing, like, let's say 25 years back, they were producing maybe about 3 million.
And the U.S., what's the U.S., 12, 13 billion? Or 13 million?
13 million barrels per day.
Mm-hmm.
Total global production is somewhere between 95 and 100. And OPEC controls a lot of it. OPEC's like, the U.S. is not part of OPEC, but Venezuela is actually a founding member of OPEC. And so there's a question of like, if suddenly the U.S. is saying, we are running Venezuela, and Venezuela, is saying, we're going to boost production from 1 million, less than 1 million to 3 million. It's like, how does that fly with OPEC, right? And I mean, do they get out of OPEC? Is OPEC... Like, there's so many questions here. And for one thing, this is what Chavez and Maduro did to the country over 25 years. They've destroyed the infrastructure there.
Yep. Billions
of dollars. You probably need $50-60 billion of money to go in and fix the CapEx right now. And by the way, it's still, Maduro's out, but his regime is still in place. It's a Chavez Maduro regime still in place. So there's still a lot of uncertainty. We won't get into all of that. But even if they boosted production, let's say best case scenario, they went from 1 million barrels per day to 2 million. Forget that. In 12 months. There's no way that's happening. But let's say they get that. Best case scenario. Political stability, all of that, right? And like, wait. That's, we're already in a situation where there's a glut of oil. Oil prices are in a downtrend, as we saw last year. Last year, it fell from $80 a barrel to below $60 a barrel, WTI, despite most of the commodity prices are rising. So, like, wait, you're putting more barrels out there. You think prices would go down. But yesterday, what happened? Prices went the other way. Energy companies did well, right? So, again, this is where I think the narrative doesn't quite fit what happens in markets. And this is why I like what you do. Like, what's the message of markets, right? And this is one reason, tying this back to bonds and portfolio, we are underweight duration this year. Last year we weren't, right? We're underweight duration. We have some exposure to cash, but we also have...
like, simplistically, underweight duration simply means what?
Underweight long bonds.
Right.
Underweight long bonds, right? Yeah. And we have exposure to diversifiers like gold. We've had gold for several years. Now, this is, by the way, another peeve with the Business Insider people. I love you guys. But the peeve is, why did you get like double Oracle for gold as well? Right? I noticed there was one other person who was like, we're giving him one of the Oracle of the Year awards because he was touting gold. It's like, wait, Ryan touted gold too. And addition to equity. But anyway, set that aside. Right? Commodity prices rose last year despite lower oil prices. This year already, copper, record highs. Silver, by the way, which matters for solar and EVs. Also, huge price increases. And then, aluminum prices are rising. Highest level since April of 2022. Cattle prices are going up. Coffee prices are going up. I mean, like...
cocoa was down like 50% last year. So chocolate's cheaper. We like our chocolate.
Egg prices are down too. So if you're getting
there's a few.
So breakfast is a little cheaper. But that gets to the idea, like, we're not quite... I'll tie it back to our inflation outlook. Or we don't think inflation is going back to 2% when all this is happening.
Right.
right? And within our portfolio, we want to diversify diversifiers as well. That's why we have gold, managed features, and all of it.
So I'm just looking the time we're doing this. So in our tactical models, we added some metals and mining ETF. I won't say exactly which one it is. You can probably figure it out. Up another 3% right now. It was up 3% yesterday. So the message of the market is what it is. Some of these things are really moving after this Venezuela news.
That's not disinflationary, right? I mean,
right.
I mean, this is where, yes, I can look at all the economic data, like labor market is weak, and say, okay, based on all that, yes, inflation should be going down. But then I look at the market, I look at all these commodity prices going up. I was like, wait a minute, what's happening?
Yeah, well,
doesn't quite fit.
Yeah, so again, maybe inflation is a little stubbornly high, but we don't see it soaring either. So that's why we're kind of in that sweet spot. Now we've gone, I think, plenty long, Sonu. Was there anything else you wanted to touch on before we kind of wrap up?
Last thing, I know we get the question about bubble and AI and all of that.
What are you talking about? I don't know what you're talking about. I've never heard this. I've never heard anyone say but it's just because the Fed printed money. The Fed prints money, Sonu. That's why
you need to divide the S&P 500 by the balance sheet of the Fed. There you go. That explains it. It's flat. It does the balance sheet.
Exactly.
But no, it gets this is not a very exciting bubble, right? Sentiment has been pretty weak.
Well,
even last year. We talked about the Mag 7. But by the way, last year was the first year in 3 years where the remaining 493 stocks contributed more to the total return than the Mag 7. Right? Off the 18% total return for the S&P 500, I think 10 percentage points thereabouts came from everything else.
And you made that chart. I love it. 3 years in a row, the 493 has been up double digits. Okay, so yes, your true leaders have been up more. That's why the market goes up more. But the 493 is up double digits. That's still better than your average year. That's not a bad thing. Let me jump in, Sonu, on sentiment. We did. This is the one, Drew, that I emailed later. Just on sentiment, the AAII sentiment poll, and I get it. Much like everything, there are flaws. I do think a lot of these people were very heavy in Mag 7. They're very heavy in crypto. That's why they've been more pessimistic. And maybe they listened to too much negativity back in April and May. But the reality, Sonu, we had almost 10% more bears than bulls on average last year. Yet the S&P gained over 16% price return. The only 3 other years in history that we saw that many more bears than bulls throughout the whole year: 1990, a recession and a bear market; 2008, last I checked, not a very good time; and then 2022, again, not a very good time. So it doesn't make a lot of sense to me that the market's literally hitting all-time highs globally, yet we still see pessimism. And trust me, I get it. There are pockets you can see optimism. There are some pockets of optimism that are happening. The Merrill Bank of America Global Fund Manager Survey, we're finally seeing some optimism from global fund managers. We're starting to see cash at low levels. I don't think it's the end. It's just kind of a process as this bull market ages, but by no means do I see a lot of excitement. And one more on tech, and I'll go to you. You mentioned tech a couple times. I see this chart floating around Twitter the last couple of days. It's great, but it's not great. It's really interesting. The last 2 years, technology, if you look at the forward PE, is flat. Technology stocks actually got cheaper last year. A lot of that's because Mag 7.
Five of the Mag 7 got cheaper, by the way.
So again, there's other parts of the market that are pricey, and even honestly, tech is still a little pricey because it still was high. But to think that, the last 2 years, how tech do? Last I checked, really, really good. 2 years ago, someone might have told you, well, technology is too expensive. And hey, listen, that's not my job to say. I just know the message of the market that earnings have gone up a ton the last 2 years, in a way justifying this, why we are still pretty much even weight, maybe the tiniest bit overweight technology and communications when you stack them together. There is career risk there. There's some things you want to be in these areas. We don't think this AI boom is over. I wouldn't want to be wildly overweight.
You're not supposed to say that.
Yeah,
no,
that's true. When you see the cover of Time magazine and it shows all the AI guys and gals talking about the person of the year, when you see Jensen is the Financial Times person of the year, those are in the back of my head and make me say, okay, I'm comfortable not being wildly overweight these large cap AI names, but I am fine being even weight, as I don't think it's over. You don't think it's over. All right, so I jumped in. I jumped in on sentiment. What do you want to add here? Yeah.
No, I think it gets back to the fact, like I said, 5 out of the Mag 7 stocks last year saw valuations fall. Yeah. Valuations were a drag on returns. They all made money, except for Tesla. Tesla is different. And then Alphabet / Google, again, none of those is a recommendation for stocks or anything like that. But Alphabet also saw valuation multiples increase, especially after October. But that gets to, when I think PE ratios, forward PE ratios, it's sort of like a proxy for sentiment. Because that's going up. That tells me, investors are more optimistic. They're ready to pay up more for future profits, right? So whereas earnings is like, that's straight out profits, right? Profit expectations, things like that. Like I said, analysts usually nail it. But the PE is interesting. PE ratio is going down for 5 of the Mag 7 told me that, wait a minute. Yes, we're talking about AI. We get a lot of questions of the bubble, but it seems like there's not a lot of optimism, but maybe that's a good thing.
So you had some chart. Did you want to finish up with like the 6-year chart? Did we talk about that one yet? Why it's not a bubble, or you've got some good ones?
I think this is my answer to why it's not a bubble. If you pull up, Drew, if you put the chart up of 6-year returns for the S&P 500, and I break it down into how much comes from earnings growth, right? And you can break earnings growth into two pieces: sales growth and margin expansion. And how much comes from multiple expansion, how much comes from dividends. The S&P 500, 2020 to 2025 is up 132%.
Okay.
20 percentage points came from dividends. So don't miss out on dividends, right? Yes, right? Now, but then multiple expansion, PE multiples, expansion, that contributed 26 percentage points. Margin expansion contributed, Ryan, more than that, contributed 28 percentage points. And 58 percentage points came from sales growth. So the last 6 years, yes, the market's up more than average, 132%, let's say 20% annualized, something like that. Most of that is a story of profit growth. We have the most profitable, adaptable, nimble companies probably in the history of the world. And don't underestimate that.
No, it's a great way to put it. I think that's a good way to end it. All right, Sonu, we're probably at the end. We've gone an hour, which is usually not how long we go on these podcasts, but I think there's so much to discuss in our episode 169, 2026 Market Outlook. One more from you, then one more from me. What are you excited about this year?
All the sports. I'm excited about the World Cup, to be honest. I'm looking for, hopefully I get to go to some matches. I'm still looking for tickets and stuff like that. But that's what I'm excited about. I will leave with this. Like I said, on our carsongroup.com/research page, there should be a blog up saying what we got right, what we got wrong last year. We try to hold ourselves accountable. We don't really think of ourselves. Yes, we put out a forecast prediction, but we try to, that's a game, right? Everyone recognizes it as a game too. Sam Rowe has, said like, it's not about the prediction per se. It's about the mindset that goes and the framework behind that, right? So hopefully we've conveyed some of that. We're not trying to predict economic variables, but we manage portfolios. We're always making choices within these portfolios. Like, what is the opportunity cost of overweighting or underweighting one asset class versus another? And I think that's a difference, between a lot of outlooks you all see as the audience and ours. Usually the people writing these are not the ones managing portfolios, whereas you, me, Barry, Grant, we do that.
Yes, we do. Great stuff there. I said our team's not always going to be right, not always going to be wrong, but we're always going to be upfront. We're going to be honest, and we're going to be actionable. We're going to make sure you understand what we're trying to tell you. And I think we've done a really good job of that the last 3 years or so, in my opinion. But maybe I'm biased, but I think we have done a pretty good job of that.
What are
my
you
daughter,
excited about? Taylor Swift's wedding?
No. Although, I'm the moron that spent a lot of money on Taylor Swift tickets in the past, but whatever, it's all right. My daughter enjoyed it. My daughter is not yet, but we're looking at schools. Hopefully soon. She's a senior in high school. Hopefully we're gonna know where she's going to go to school, and that's going to be exciting. Both my boys. I mean, I do this stuff all day. I talk to you and Barry, Grant all day. I love this stuff. I absolutely love this stuff. But all I other do is just run around with my kids and watch them play sports. Like, my boys play basketball. Both of them are pretty good. So, like, I'm enjoying the next couple of months of basketball. Then we get into spring AAU basketball. And I start traveling a lot. Like, I start getting real antsy around the house. Maybe antsy is the word that my family wouldn't use. Like, maybe, I don't know. They should, get that. I like to be on the move. I love to be on the go. So I am looking forward to some travel. Then I kind of, it's like a love hate. You're like, oh my God, I got to be on a plane 4 weeks in a row, 5 weeks in a row. Then when I'm home for 3 weeks, I'm like, oh my God, I need to get out of here. It's kind of, and his family probably agrees.
Luckily, my wife is not listening. She doesn't listen to the podcast. No, it just goes over her head. Otherwise, she'd be like, wait, you love to travel?
Yeah.
Same thing. I enjoy meeting, amazing advisors, our clients. Same with you. I know that.
Yeah. I mean, there's industry events, but my favorite thing is getting out with our Carson partners around the great country that we have and talk with their clients and how we see the world. And obviously running the U once in a while face to face, which is always special as well. So listen, everyone, we appreciate it. Thank you so much for listening. There's a ding. I don't know, that ding means we got to shut up, Sonu. We've probably gone long enough. But we have a lot of fun doing this podcast. We did 52 of them last year. We're going to do 52 of them this year. As long as you keep listening, we will keep doing them. The Carson Investor Research team will continue to lead the industry in communications and how we see the world. And again, being honest and upfront and being very timely. And it's things that we're built on. We're going to keep doing it and just keep giving us those comments, give us likes, give us follows. We really appreciate all those things, help build this brand. We got some other things. Maybe I'll just say it. We're looking to do more live streams this year. It's out there, right? Once you get it out there, it's out there. So that's out there. We're looking to do more live streams this year to help build the podcast as well. So stay tuned for that. And one final thing, Harry on our team is helping us do some really cool stuff. We're starting a Charts of the Week blog. So carsongroup.com/research. Every Monday, we're going to do it. Who knows, maybe different days too. But I think one of the things that we aren't as good at, you and I create a ton of charts. We don't always get them out there maybe like we should or make them as easy to use as we should. That's just a thing that, it is what it is. Well, Harry's fixing that. So we literally are going to have what we call a Charts of the Week blog. Chart right there, a couple bullet points, very easy for financial advisors to leverage and use and share with their clients. So I think that's something I'm also really excited about, is sharing more of our stuff that we're already doing, but getting it out there so people can leverage and use it just that much more in a nice, compact way to share it. That's something I'm excited about too. Everybody, we went plenty long. Thank you for staying this long with us. We'll be back next week. I guess it's just a regular one, right? Next week's just a regular one.
We'll have payrolls to talk about.
I can't wait.
Something.
Oh, so excited.
Back to regular business.
Yeah. Maybe I'll give an update on my tennis elbow if I'm even doing the exercise. Keep me accountable, everybody. Reach out. Say, Ryan, do your exercises. All right. Thanks, everybody. We'll see you next week. Take care. Bye-bye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.